Good morning, everyone, and welcome to the launch of the Kent Property Market Report 2021. Hard to believe it's the 30th edition of the publication. I'm Graham Mitchell, one of the founding directors of Caxtons, and I'll be attempting to chair this breakout room this morning. The topic for the discussion in this breakout room is the logistics market. What is the potential for Kent? We're joined today by my colleague Mark Coxon, a director of Caxtons and head of our commercial agency division. I would like to also welcome Tony Watkins, development director of Panattoni UK. As many of you are no doubt aware, Panattoni are currently very active in Kent, being the developers of Panattoni Park at Aylesford, which I believe comprises 1.9 million square feet of space on the former Aylesford newsprint site. I will shortly be asking Mark and Tony to give us a brief introduction to today's topic, and I will then be inviting you all to pose questions to Mark and Tony and foster a discussion. This session will finish at 8:45 sharp, when we will all need to join the main stage for the main presentation. Can I please ask you, anyone with a question, to raise their hand, either virtually or actually, and I'll try and involve as many of you as possible. Could I also ask you to keep your microphones muted unless you're asking a question? Now I'd like to invite Mark to introduce himself and to provide a brief overview. Mark.
Hello everyone, I'm Mark Coxon. I'm Director of Agency at Caxtons, formerly partner at Cushman & Wakefield. Just like to run through the industrial warehouse market, how we've performed this year. What year it's been for industrial in Kent, but not only Kent, South East and the UK. In certain locations, Kent has actually outperformed the South East and the national average in terms of rental levels, land values, and in some instances, investment yields. The county has not been without its issues, similarly affecting the rest of the UK with construction costs, supply chain delays, which are currently being absorbed by various loans like recovery loans. Also biodiversity costs, which come into law in 2023, which can add another 10% on top of build costs. Kent remains very affordable compared to other locations within the South East, within the M25, which these locations are similar in distance to central London and the South East. In some instances, land values and rental levels are up to 50% less than their counterparts in locations like Park Royal and Tottenham, where rents are in the order of £30 per square foot, compared to Dartford, for example, at £14 per square foot. Take up for the year is up from 850,000 in 2020 compared to 3.5 million in 2021. Those buildings servicing online sales this year has accounted for 40% nationally compared to 81% in Kent. Speculative take-up nationally is double the national 5-year average, accounting for 35% of the market compared to Kent at 90%. The larger deals this year in Kent being Powerhouse, 2.3 million square feet and 450,000 square foot to Amazon and IKEA. Mighty in Orpington, which just sat outside our Kent boundary, 105,000 square feet to Amazon. The Arc in Aylesford, 68,000 square foot to Schragon. Tridge in Sittingbourne, 72,000 square foot to DHL. And a prime example, M2 CityLink in Rochester, 72,000 square foot to Argos. More notable lettings of existing stock, including Bastion in Dover, 85,000 square foot, Hartley in Sittingbourne, 148,000 square feet, and Trident House in Sittingbourne, 62,000 square foot to Allideck. There was also the vacant possession sale of a former Cummings warehouse at Manston, totaling 163,000 square feet. Supply, there's currently 240,000 square foot of existing warehouse units in Kent in 10 buildings, over 20,000 square foot, which leaves less than 12 months supply if we exclude the powerhouse lettings. There is, however, 900,000 square foot currently being constructed within the next 12 months, including Crossways Business Park, Dartford Works, Dartford X, and located in Maidstone. There's just over 270 acres available for design and build, or in the process of getting consent, including Medway Park, Rochester, Panattoni, Aylesford, Cold Harbour Lane in Aylesford, Wrenbridge, G Park in Sittingbourne, Gaisley, and Waterbrook for GSE in Ashford. At Ashford 34, rental levels nationally have increased by 14% this year, with certain locations in Kent, such as Maidstone, increasing by 15% over the period. National rental levels are forecast to increase by 4% over the next 5 years, with rental levels over the last 5 years in Kent increasing by 9% alone. We see the national level for Kent potentially doubling over this period. Investment values for prime single-let investments have outperformed the national average of 3.5% compared to 2.75% in Kent, which has jumped of 1.5% within 12 months. This is taking into consideration Quadrant in Dartford, which was sold 12 months ago, a multi-let scheme let to one tenant at 3.5%, where we're seeing now Aylesford Business Park, which is 110,000 square foot, sold to RPT Global at 2.75%. In addition, Mighty in Orpington, 105,000 square foot, again just outside our borough, sold to Aberdeen Standard at sub 2.75. Yields for secondary single lets are similarly both nationally and Kent at 5 to 6%. National land values increasing this year throughout the UK at 40%. All locations within the M25, including Dartford, have increased by between 4 to 22%. Outside the M25, Ashford, for example, has hit the national level at 40%. Prime multi-lets in Kent and UK currently stand at 4.25%, but secondary multi-lets only slightly behind at 4.65% in Kent. If you consider secondary multi-lets in West London at sub 3%, there is potential for a downward movement in yields here. Funding yields are about 5.25% now. Finally, infrastructure improvements in the county will undoubtedly create opportunities in the county at places like London Resort in Northfleet, the Lower Thames Crossing in Gravesend, a new Junction 5A at the M2 at Sittingbourne, and Junction 7 on the M2 at Faversham. That's the end of my presentation, but it would be good to have a chat through any questions you may have.
Thank you, Mark. I'm just looking to see if Tony is with us. I can't see Tony with us.
No problem, Graham. We've got lots of questions to run through, no doubt, and I'm sure they'll be doing this. Yeah.
Well, while we're waiting for Tony, don't know if anyone's got their hand up. I can't see anyone's hand up, but I'll kick the ball off, Mark, if I may. Why is Kent performing so well?
Well, I think basically Kent has been undervalued for the last 5 to 10 years. It's only the last 18 months, 2 years, just pre-COVID, where the industrial market has really picked up. And as you see from my stats, rental levels and yields have really jumped up. Also down to availability. I mean, this year, even though we're moaning about lack of stock, there's still a lot. There has still been a number of key buildings which has been speculatively developed. So these buildings, for example, like M2 CityLink in Rochester and Trilogy in Sittingbourne, were actually constructed and pre-let before PC. Also, you've got to remember that Kent has much cheaper rent, as I mentioned in my presentation, and in some places we are 50% below those locations around the M25. And you think of places like West London and Tottenham, which I give as good examples, which are all equidistant from the town centre to places like Dartford, 50% less. And with regards to access to the central area, the the same sort of timescale. The land values as well. I mean, you know, looking at where we are in Dartford, 2 million. Moving out, you know, we've still got land values over on the M2. As far as Sittingbourne, for example, still at 600,000 or 700,000. And considering that rents are now in most locations double digit, so we're pushing those rents to £9–10 per square foot and above. When a developer does his property appraisal, he'll still be getting his 15% on cost, but paying a lower land value. I mean, land values are interesting. Up in North London, you're £9 million an acre. So I think to make those sort of schemes stack, even though you're paying a full figure, you're really going to have to push that yield on the exit, which again you can do in Kent quite easily at a lot cheaper land value. Consequently, your return is probably slightly higher. Hope that answers your question, Graham.
Thank you. Have we got any other questions? I've got a couple coming through otherwise. I can't see any hands up at the moment. What sort of occupier is Kent attracting at the moment?
Well, again, as you see from my stats, we've had the largest percentage of online retailers, which you'd expect throughout the UK, and all locations around the UK have been reporting that. Slightly less retail clients. I think the reason for this is a lot of companies going online, similar to Argos, up on the Medway towns there, also taking a lot of their kits out of the store and going online. Every multi-let industrial estate we let in Kent, every new build, we're probably 50% national occupiers still, 50 to 75%. So we've got all the big names. And then we usually let 25% to the local companies, but with good covenants. So, for example, you may get a number of buildings let to local companies, not always a great trading history, but as long as you get rental deposits. Still very few manufacturers. We've still got very few B2 operators now, which is understandable. A sprinkling of B1C occupiers, but predominantly it's the B8 companies who are taking the space. Kent's always been very successful with fruit farming, cold stores, etc. And over COVID, we thought there'd be a lot more cold stores coming up. And I think I only did one, maybe two deals over that 12 months for cold stores. And nationally, it wasn't a great amount. So generally, Graham, the answer to your question would be quite a mixed amount there.
Thank you. Are we just looking for any other? Otherwise, I'll go off the ones I've been sent through. Can we see rents rising? Have they started to rise yet?
Well, as I've said, we've had a phenomenal rent rise this year, well over the national average in certain locations at 14%, which is great. And then some towns in Kent are well below the national average. And it's those towns which I think are going to increase dramatically. As I said, we are in double-digit territory in most of the West Kent locations. We're keeping full rents at the full asking rental. If there is a deal to be done, we'll probably load the deal with rent-free, which brings down the net effective rental. National clients don't mind this. Sometimes needs a bit of explanation to the local companies. We just look at how much they pay per year, so you have to do a net effective rental analysis to show how much those companies are paying. So generally still a lot of potential for rental growth. As I said, over the next 5 years, we're looking at 4% growth nationally, and seeing as we've seen 9% in the last 5 years, I can't see a problem in that rental rise rising year on year for the next few years, providing the economy goes as it's going, and there's still a lot of money coming into the UK for investment, which you can't forget, coming out of Europe and overseas, looking to buy a safe haven. Obviously, you know, the old cliche, industrial's having its day. I mean, yields for warehousing are as similar or less than Western offices, which has never happened before. So the answer to that question, Graham, is yes. We'll see rent rises. I personally can't see anything on the horizon which will stop that. And you've also got to remember that there's still a lack of stock, even though, you know, I gave you a great stat of £1 million in the pipeline for construction, sorry, 1 million square feet in the pipeline for construction. These will soon go. We've got a scheme down at Locate on the M2, which on the M20 on Junction 8, which we've already done a couple of pre-lets, and we've only just put a fork in the ground. So all in all, a very good story. Ales with Panattoni, which Tony's involved with. Again, they've got a lot of the scheme, a lot of serious interest in the whole of the scheme. So frankly, you can't go wrong. And I'm very interested helping investors and developers find those locations which actually make us money. And, you know, can you make much money, you know, buying investment 2.75? That's not really the thing. That is basically for long-term income, which is great. But where can you make money straight away? And I point to the cliche places like London Resort. Will it ever happen? Yes, it will. I've just sold a 35,000 square foot warehouse within the Paramount zone, which basically sold to an investor. And you know, this could get compulsory purchase over the next 5 years, maybe longer, maybe shorter. But there's great compulsory purchase packages for these companies. So this investor's bought this with the intention of letting it, not at a prime rent, a good secondary rent, get a local tenant in there, and providing you haven't got a manufacturer who, you know, if they are dispersed, then they'll have to go. They'll have to obviously go elsewhere, but the machinery takes quite a lot of time to take elsewhere. This sort of unit will let your distributor, who can up sticks quite easily, get a nice compensation package. And other locations that I'm really pinpointing for expansion in the forthcoming couple of years, 2 to 5 years. Lower Thames Crossing in Gravesend, which again we've got time to go, circa 5 years. There's lots of land around there which will be becoming available. And you've got to remember these areas like Northfleet and Gravesend, they're so near the M25, yet their rents are sub, you know, £10 per square foot. Goodman will do phenomenally well at their Crossway scheme, where they're building larger warehouses right on the M25. The other place is really to have a think about with regard to making some money. Junction 5A, I'm telling you all my secrets here. For Junction 5A of the M2 and Sittingbourne, there'll be a new junction there, and Sittingbourne again is really taken off. If you remember, some of you might remember, Morrison's took 500,000 square feet 10 years ago. At the time, they were looking at one of my big boxes at the bridge in Dartford when I was at Cushman and Wakefield. I was letting for Sainsbury's. They bought this, they built this lovely big 500,000 square feet. Rents at the time, 10 years ago in Dartford, 775. Now they're, you know, 12 plus. But Morrison's, who we had a lot of detailed conversations with, did a bit of a U-turn on my building, unfortunately for me, and took a 500,000 square foot up at Sittingbourne due to lower rentals. And I think at the time you're off £5.50, lower land value, although Gaisley did the pre-let. So it just shows that market. That was the first big deal to be done out there, 500,000 square feet, and subsequently at Trilogy, where we've just let to DHL. Interesting enough, the park there, I acted for a tenant, Doka, 3 years ago, two and a half years ago, and we bought land for 450,000. Fine, built a nice 50,000 square foot, and the site opposite there was on the market, and I thought, you know, you've got to be paying more than 450 when land value is probably in Dartford at the time. Good reckoning. Ready Reckoner was about 1.5 million. So yeah, we paid 550. So land values there now are going up to well, nothing in the market, but you'd probably put something on for 600, 700k. But how cheap is that still? And still very good demand, especially when we're creating schemes like Trilogy. And I think other locations like Ashford, for example, there's very little spec development. We've got a 34,000 square footer, Ashford 34, which we've got serious interest in, even though we've just put a spade in the ground. Waterbrook, which is the other big scheme, got planning for 100,000 square foot, has got interest. And the big Mojo site on Junction 11 at Ashford, which was going to be a big logistics scheme, sold last Christmas to the government for lorry parking. So again, you know, Ashford, a fantastic location to find land in. And funny enough, there's a site which I've been looking at. Probably did my appraisals of 600,000 or 700,000 an acre. Well, that's probably going to be thereabouts. Just got on the offer here, £1 million an acre. Now, if that actually transacted, that's a whole different ballgame for Kent. And actually, that will push those values on the Medway towns right up and Ashford. So hopefully that's answered your question, Graham, in a roundabout way.
Yeah, well, following on from that, I've got a question here from Keith Grimley. Says, perhaps not pure agency question, but where in the county do you expect to see land coming forward for new development? And what is the key factor in driving this, would you say? I know you've just touched on Ashford, but...
yeah, I think that's quite an easy answer. And with logistics and distribution, it's all about access. And as soon as I've just mentioned, as soon as you put a new junction in, junction 5A on the M2, and don't forget junction 7 on the M2 at Faversham, suddenly a lot of landowners start thinking, you know, this is a logistics location, probably more so than Sittingbourne and Faversham. Faversham, as I call it, is on the edge of the London markets. I call it a London market where a distributor will come out of the M25 and think, actually, I can still distribute well from Faversham because of from Sittingbourne, for example, which was the sort of perimeter for just in time to get back into London. Faversham is only about 10 minutes further than that, and the rental values and the land values will be cheaper at the moment. That will go up. So I'm starting to combine Faversham into our London markets, which would be phenomenal for like the Duchy of Cornwall, for example, who's doing a big business park business park scheme at Junction, but with some logistics potentially there as well. So very exciting times. But the answer to your question, Keith, is anywhere where you're looking at good access. Having been in the market for so many years, I've gone through a couple of recessions, and you should never buy, and people always forget, in a poorer location, because the market suddenly ducks, duck dips, you might be stuck in the warehouse, which is the wrong location. So it's really down to access. And often it doesn't matter how you present the warehouse. This is for secondary buildings for refurbishment. As long as you've got good yard space, it's got good eaves, the building will always let. Obviously, the new build market is getting more sophisticated, and ESG is going to be a major part. So I'm asked questions every day by developers, what should we be putting into our building? And a lot of companies have now got their own ESG person who looks after that side of things, and they've got to tick the box. So solar panels and all the other things which go along with ESG are going to be very phenomenal. Can you add extra rent? Yes, you probably can. You can probably add a little bit of extra rent to the appraisal, which will obviously help the land value. My only concerns, I think, are I'm going on a little bit more from Graham from Keith's question, but with regard to biodiversity costs, and they are hitting. And that leads on from ESG. That's hitting the law by 2023, so we've got 2 years. Every local authority around the UK, I think it's slightly different approach, but it's adding on about 10% build cost, which developers are going to have to factor in. Will that affect land value? Probably not, because there's just lack of land. So I'm trying to get this back to Keith's questions. And again, within Kent, we've got a finite market, but again, it's looking at these locations which will actually create a good investment, because a lot of these new builds are traded. Dover, another location which hasn't had development for many years. There's a couple of sites which are, or one site which has been on the market recently. There's very little stock. I do ask developers to look at some of these eastern locations in Kent. A lot of developers will look at, your Dartfords, your Orpingtons, even coming out to Northfleet places. Rochester's been very popular, and even Sittingbourne, wouldn't have been for everybody selling to Barwell Capital and Tavis House, but want to do the appraisal. Gets a little bit more parochial. You're focusing in areas like that, good small secondary markets, small units, etc. Again, lack of stock. But hopefully, Keith, that's answered your question.
Right, I've got another one from Sean Galvin. I think this goes back to rental increases. So how sustainable do you think the rental increases are?
Sean, nice to see you. Nice to hear from you. Anyway, I haven't spoken to you for a while. I think it's very sustainable. And again, I keep saying, because our rental levels are still very low. We never have a problem increasing rents. Having been on the landlord side myself, and being a London agent, we've always pushed rents well above the comparable. Never had a problem. And loading deals with rent free, again, obviously affects the investment value, but I think the more importantly is keeping the effective rental up to a full amount. Obviously helps with rental values. I've never had a pushback on any of our new schemes so far on rental in the 10 years I've been over in Kent, and indeed, within the 10 years previous to that when I was in London. So I'm not concerned about rental levels. The rest of the UK, or not the rest of the UK, but London, I'm sure there are issues. But again, if you need to get into the city and the West End, these areas like Potmore, Tottenham, and even Croydon are fabulous. So Kent, still well behind the norm, and especially these locations in Kent, just on the M25, which are fantastic for logistics. Haven't really seen, are still got potential for growth. If I could estimate growth, I'd be a very wealthy man. But from the stats, it's a no-brainer. With 5% over the next 5 years, and 9% historically over the last 5 years in Kent, we're safe for another 5 years quite easily. It's just getting that rental figure, just pushing it, and then void levels are coming right the way down. I was so gobsmacked on how well we've performed, or how well the county's performed, if not the country, on pre-lets, which is fabulous for the market. And long may it go on, Sean.
So I've got just had a message to say, unfortunately, Tony Watkins can't join us because he looks as though he's probably got COVID and he's totally wiped out. So he's sent his apologies.
No problem.
But I've got an observation and a question here from Neil Chatterton. I went to see something in Sheerness yesterday where I haven't been for a long time, and was struck by how good the road link was to the island, and that there is a lot of available land. Is there much demand there, especially as presumably land values are much lower? And he goes on, hang on. Yeah, I see Aldi have a massive distribution depot there.
Yeah, I think Neil, thank you, Neil, because I think that's a great example. One of these locations which has been sleeping giant, even though I'm talking about areas like Faversham, Sheerness, as many of you know, Kent, you've got two peninsulas, Isle of Grain and the Isle of Sheppey. Sheerness is beyond the bridge. But actually, that beyond the bridge, as Neil's rightly said, the motorway access is fantastic. There is a lot of land up there. How much available of it ready to go, I think it's limited, but I do completely agree that is another spot for a land increase. And I think in the market, you do get a lot of these larger requirements wanting freehold land, which again, apart from deals which we can potentially do on the Goodman side at London Commercial Park, London Medway Park, where we can do freeholds, it's probably the only show in town. Sheerness and Sheppey is just over the border. So where Morrison's, a good example, took Sittingbourne, there could be another deal being done over the river, and again, you should put that onto your radar developer. But I'm not quite sure how much land available is there. We've done a land search recently. Crown Estates have got some. I'm not sure if that's ready to go, but we'll certainly look into it. We're talking about fine, but on the secondary, the tertiary markets, where don't forget that makes up an awful lot of Kent. A lot of these parochial areas, I say that in a nice way, have got quite a small market. So Sheerness, for example, the rents there will be quite low. Why wouldn't they be over 10? I don't know. These rents have got to be pushed. Tenants have had an issue throughout Kent. Those tenants paying £6 or £7 per square foot. Even in places like Aylesford, up to a couple of years ago, a lot of them had to be educated, but now the rents are £10 per square foot. You tell them that, they go away, come back and say, yes, you're right. So I think we've actually displaced quite a few of those tenants who are looking at cheaper rents because that's all they can afford, which is fine. So they come out, they go into farm buildings elsewhere, and actually investors and developers always need a bit of churn. So from the secondary or tertiary multi-lets where we can get tenants out because they won't pay the high rents, and obviously we can move those rents on. So investors, as you all know, I'm sure we've got quite a few investors and developers here today, will know that actually, if you get a fully let scheme, that's not always the best scenario, unless you've got long 15-year leases. What you need is breaks, and you need churn. I'm involved in a couple of investment sales at the moment on new build or multi-lets, and actually the investors have looked at the schemes. It could be a 5 or 6 unit scheme, want to keep, and often being a great agent, I've always let on, a lot of my deals on 10-year leases, want to see these 5-year breaks just for churn. And even 5 years, where is the value add? So if there's 1 or 2 buildings available, that's not a major issue. And actually, perversely, that actually might affect the yield. So where you're sort of at 4.25%, for example, on a multi-let, on a prime multi-let, that yield will obviously improve. And I think I gave the example earlier on multi-lets at, secondary multi-lets at 4.75, which is quite a very small difference between both. You've really got to see that prime multi-let go sub 4. And again, even with the fact that you can have a void, that'll help the investment. I digress slightly, Neil, but great to bring up Sheerness. Not sure about the land availability, but I think there's potential for rental growth. It's just getting confidence to developers and investors that these areas, when you introduce a site in somewhere like Sheerness or somewhere a little bit further, it's not core. So whether the developer wants to spend more time, working on something in central London, or whether there's more competition, more and more developers come to me and say, Mark, we're not going to start bidding on sites which are on the market. Because obviously, you might get 9 or 10 developers bidding at high rates. It's the off-market opportunities which takes things forward. Which here at Caxtons we really do try to wreak out. So hopefully, Neil, that's answered your question in a roundabout way.
Thank you, Mark. I've got another question from John Foster. Could you say a little more about Lock 8 at Junction 8? 2 pre-lets, I think you said. How confident are you that the site will be delivered by summer 2022?
Well, we're very confident. We've got contractors working through it. We've got a great range of different sized buildings from 10,000 square foot plus, and actually we've covered the whole market. And apart from Panattoni at Aylesford, which are big boxes, we're mid box and smaller. There's nothing on the market. So deliverability. As you've seen from my pre-let stats, the pre-letting on single lets is phenomenal. I mean, on multi-lets, over the next 12 months, it's going to be a very exciting time. So haven't really got a problem with that. I was just going to, so hopefully that's answered your question on locate. I couldn't actually get my slides up at the time, but I can run through a couple if we've got any time at the end, just to have a chat through some of the graphs, which I've spent hours doing. Unless you've got any more questions.
I've got a couple more questions, Mark. I've got one from Mandy. To what extent might demand from national companies spread eastwards in Kent, or will that just stay as a local market?
No, as I said earlier, good question, Mandy. But I think again, all my new schemes, we're getting probably half to three quarters on national inquiries. The local market, this is for larger buildings. The local market is there, and we always welcome a local company with open arms. On the smaller multi-lets, let's talk about the smaller secondary and tertiary schemes. You're probably the other way around. So it's probably more local companies, unless you're trade park, than nationals. But on any secondary scheme, you'd probably get 75% local, 25% national, which isn't a major issue. That's what you'd expect. On the bigger multi-lets, you probably, sorry, on the multi-let buildings around Kent, on the new build, you're probably 50-50. And then on the so I think with regards to national tenants, we get as many. We haven't got the international airport like Heathrow, for example, but we've never had a problem in attracting national companies. Locating Kent do a fantastic job at bringing these companies in from overseas, from Europe, etc., and retaining some of the local companies.
This is a question really for everybody, but Helen Sharp says, do you have any information regarding Folkestone? Do you know of anything that's happening in Folkestone, Mark?
There's no big schemes at the moment, which is unfortunate. I think that if the site came up, there will be a multi-let scheme. I do my analysis on each town every 12 months because the market changes quite rapidly, and we really dig down. So I can probably put my hands up and say I probably haven't done that for Folkestone for the last 18 months. And that probably is again another town which you could probably fit another small multi-let in. You'll be able to let them. And our letting voids are usually about 12 months. After PC as well, but usually obviously pre-letting, not so much on the multi-let. So I haven't got an answer for you. I'm not sure of the availability of Folkestone. Again, when I get back to the desk in an hour, I'll start googling a little bit of Folkestone, because that would be a great site. Probably not for national. So national companies will probably shy away from these parochial towns, but from a good local developer, providing your agent can give you the rental analysis for the last 12 months take up, and really it's down to the supply and stock. If there's no competition, it's a no-brainer. It's amazing that you might not have any inquiries on your schedule for that town, but as soon as you get something built, they all start coming through.
Thank you. Well, I've got no more questions at the moment, but you've got 5 minutes if you want to highlight anything from your slides. And then we've got to go back to the to the main stage.
No problem at all. So yeah, I'll talk about investment and land values, but you see from this slide very clearly, national average 40% land values in the last 12 months. Always quite dangerous to actually just analyse the last 12 months. And usually, I think in the past on the Kent Property Market Report, we usually analyse 3 to 5 years because you might only have 2 major deals. Because this year has been so phenomenal, I've just really analysed the last 12 months. Next year, I might be analysing a little bit further out. But as you can see, I really wanted to show you where Kent is compared to the M25. I didn't include Thurrock, which has actually been it's always been lower than Dartford. In the market there, Dartford and Thurrock quite similar, but actually the last two years previously, Dartford actually took off and rentals actually increased over Thurrock north of the river, which you wouldn't expect because obviously Thurrock's got the access to the rest of the UK, but it did. So Thurrock struggled slightly, but now it's back on an even keel. And then just briefly, because I know time is limited, just picking back on my my chart on investments, and you can see The prime single lets there at 2.75 in Kent, national 3.5. The secondary single lets at 5.5. Again, we're bang on to the national at 5.6. The multi lets at 4.25, and the secondary multi lets at 4.65. So it's that's percentage which I see as an opportunity where these prime multi lets at 4.25 can go sub 4. Here, sorry, so the most recent deal, Trinity Trading Estate in City Bourne purchased at 4.65, a large multi-let, but with quite a lot of asset management, cracking figure. But if you compare that to West London at sub 3%, we're nowhere near. There's very few funding deals which have been done. And a few more bits and pieces just to cover up. Total investment this year was 295 million, which is phenomenal compared to 2018 levels, almost double.
One more question, Mark, while we've got time. Another one from Keith Grimley. Are you seeing any food sector activity, dark kitchens or food production hubs?
Funnily enough, we've had a few of those on the smaller units, and because of COVID, we would have expected those. I'm doing a small deal with Nando's at the moment for exactly the same, but very much on the smaller side. You'd probably have to analyse the demand through somebody like Locating Kent, who'd have probably some of those inquiries coming through, but I haven't seen a lot of them. The food sector, again, as I mentioned in my presentation, has reduced slightly due to the online scenario, which is interesting. So over the next 12 months, it'd be really interesting to see where the retail market goes for logistics.
Great, thank you. Just having a look to see if there's any last questions. Before we wrap up, to come to the breakout room, and I hope that introduction to the logistics activity has been interesting. Thank you very much, Mark, for your one-man show. And we've now got 2 minutes to log out of the chat room and to go on to the main stage where the main presentation will be taking place. So thank you very much all for taking part, and I'll see you on the main stage.